Property investing and property trading. Most people think they're the same thing. They're not. And the model that you choose changes everything. Your returns, your timeline, your risk, and whether you actually end up with the lifestyle you got into property for. Let me break down what's actually different. There are two models you can use to build wealth with property. Most people think they're the same thing. They're not. And confusing the two is the single biggest reason most property investors end up frustrated, underperforming, and stuck. So let's break down what's actually different. The traditional investing model works like this. Buy a property, rent it out for income, wait for capital growth, and eventually, maybe in 10, 15, 20 years, sell it for a profit. This model works. But it works over very long time frames, and it requires patience and deep pockets to weather the holding costs along the way. Property trading is a different model entirely. Source undervalued properties through systematic deal flow. Add value through renovation, repositioning, or creative structuring. Sell for a profit within months, not decades. Then recycle the capital into the next deal. This model generates cash, predictably and repeatedly. It's not speculation, it's business. Here's the core difference laid out side by side. With investing, your profit comes from market appreciation, something external you can't control. With trading, it comes from value creation, something internal you drive yourself. Investing locks your capital in an asset for years. Trading recycles capital between deals. Investing generates rental yield that's often negative after real costs. Trading generates cash per deal. Same asset class. Completely different model. So why does investing frustrate so many people? Because the returns are slow and unpredictable. The cash flow is often negative once you account for all the real costs. You can't access your equity without selling or refinancing. One bad market cycle can set you back years. And that financial freedom you're building toward, it always feels like it's perpetually 5 years away. Investing builds theoretical wealth, but it rarely builds the lifestyle people actually want on any reasonable timeline. Trading appeals to serious operators because you control the return. You generate cash per project, not per decade. Your capital recycles. You don't need more money, you need more deals. You can scale through systems and team, and the timeline from starting to generating real income is measured in months, not years. It's active, it's intentional, and it puts you in the driver's seat. Now, people often assume that trading is riskier than investing, but the opposite is often true. With investing, you're exposed to market movement for years or decades. One interest rate hike can change your entire position, and you can't control the outcome. You're along for the ride. With trading, each project is a short, contained cycle. You know the numbers before you start. Your exposure window is months, not decades. Risk isn't about the activity itself, it's about the system behind it. The smartest property operators don't choose one or the other. They use both. They trade to generate cash and free up capital. They hold when the cash flow is genuinely positive and the property fits a long-term strategy. And they never hold a property out of default, laziness, or because they can't think of what else to do with it. It's intentional, not automatic. Here's the deciding question for every property you own or consider buying. Am I holding this because it makes strategic sense? Or am I holding it because I don't have a better plan? If the answer is the second one, you don't have an investing strategy. You have an absence of strategy. And that's a problem worth solving. Here's the shift. Property investing is about owning assets and hoping they grow. Property trading is about building a business that creates value. Both work. But only one gives you control, gives you cash flow, and operates on a timeline measured in months rather than decades. The question is which model actually fits what you want out of property. Two models, same asset, completely different outcomes. If this reframed how you think about property and you're ready to see what the active model looks like for you, check out the link below.